I'm going to give these 6 golden rules that I made up for the boot camp. The last one's going to be the most important. Stay calm when you're talking to a customer. Use questions instead of statements. We want to know what's going on with our customer. Never debate a hardship. It's just a losing battle. You're not going to work. Anchor the conversation to the vehicle and about how important the vehicle is to the customer.
That's really good.
Get a path forward. And if that is paying right now or paying next Friday, let's get a path forward so that we're all on the same page. And this is so key, the last one.
Hello and welcome to the Independent Dealer Podcast. Luke, it's rough out there, man. It is rough.
Well, it's going to be good because it's tax season. But what you don't want to do, Jeff, is screw up the rest of the year because it's tax season, right?
Don't we all know that our underwriting gets incredibly loose? All we look at is down payments. This is the time of year to put a lot of bad books, a lot of bad contracts on your books, right?
Yeah, it happens. It's been
in there like nonsense.
Yeah, and it's been happening for a while. So we need to go back to the basics when it comes to underwriting, Jeff. And and talk about collections.
Well, I mean, you've seen that a lot. We talk about this, we documented it, and really like went over all the stuff with Tricolor and a lot of other buy here, pay here's that are big and in the industry and in our circles that are going under. And so much of that starts with bad underwriting, just being fast and loose with the application process and the scoring models or your underwriting criteria. And we just start slinging it like it's post-COVID, right?
Yeah. Not post-COVID, in COVID. So, and not only, Jeff, does it take out buy here, pay here dealers, it's taken out a big lender. And that's a big deal.
Big lender.
Big lender, big deal. And that avalanche just starts and it rolls downhill. So today, let's talk about best practices when it comes to underwriting, because everybody needs to hear it, because it's about to be time to sling some paper.
Yeah, and I want to make sure we go a little bit deeper on this. So let's try to skip over some of the real basic stuff, okay? Because I think everybody listening to us at this point knows stability, ability, character, right? Like we all know payment to income. We all know, time in the area, time on job. All those kind of things are crucial for good underwriting. So let's maybe dig deeper on some of the missed areas or the ones that aren't getting as much attention that you think are causing crucial flaws to pop out in this dam.
So one of the first things I'll tell you is term's causing a problem. And what causes the problem of term is ACV of the car, gross profit, and pricing. And the reason term follows is that you're stretching the note out too long, Jeff. Buy here, pay here dealers, if you go back to the basics, it was essentially a 12-month loan, an 18-month loan, 24-month loan, right? Mm-hmm. Those loans performed the best, and it was perfect for our customers. And all of a sudden, we decided that some people have decided that 48 and 60-month loans are okay. I'm here to tell you that the driving habits of the family that buys your buy here, pay here car will not allow your car to reach a 60-month term, or a lot of times a 48-month loan. And that's a real problem.
Okay, so here's my problem with that, Luke. I would love for all of my loans to be 12 months long, but my customers can't afford a $1,500 a month payment, on a 2012 Ford Focus. It's just not happening. So I think in my defense for extending term is I was trying to keep the monthly payment affordable. So how do I reconcile making it a manageable monthly payment and saying that I need to keep my term short so I can get my principal back and get out of this car sooner?
So the second thing I was going to tell you that's causing a problem is payment cost. And if we look back before COVID, our average payment cost probably in our industry was in the 400 to 450 range. And automatically it jumped to 500 to 600 range. And it's putting a really big bind on our customers. And so how do we do it? There was there was an artificial jump in ACV during COVID, and we have to be determined to get back to pre-COVID ACVs when possible.
So I need to buy a turd.
Well, unfortunately, buy here, pay here for a long time wasn't the best car on the planet. And so
customers don't want to drive turds though.
Yeah. Okay. They don't. I understand that. But at some point, the customers are going to be having to drive turds because that's what their credit is going to allow them to drive. And I'm not saying a turd because there used to be a lot of great cars in that $4,500 price range that you could buy, do your recon, sell for $99.95, and the customer would be in the loan for 36 months max. And I think we can go back there. I think we can get back there. Now, it might be harder. And either we have to, lower our grosses, which we don't want to talk about doing that anymore because it's, there's no margin anymore anyway. And so how do we get there? I think it's being very selective on the cars we buy. And maybe it's reducing the amount of cars we sell to make sure we have the right inventory.
That's an interesting thought. So I see two answers there that you said that I think would be even approachable for most buy here, pay here's. And that is making sure my grosses are in line, right? Now you want to make money, but we all know in the buy here, pay here money, you could make a ton of money, but it's not money you're going to ever collect.
Yeah.
So just having phony grosses makes no sense. If I want to put a $10,000 markup on every single car and stretch all my terms out to 60 months, I could keep my payments affordable, but it's ridiculous because it would never be collected.
You never collect it. What happens? Let me talk about that for 1 second. What happens a lot of times is people inflate their gross because they're working with a line of credit, and the higher they can inflate the gross, the more money they can pull out. And that's a bad situation too, right?
Yep.
So you have to be able to play the game where the grosses are in line, and I'm not taking 60% every time I sell a car. Maybe I'm taking 30% or 35% or 40% every time I sell a car to make sure you're staying within that window. The bad game is to have high grosses and high advance rates, because then you're going to go out of business. And because your portfolio is just not going to perform properly.
Yeah, it seems like, I don't know why lenders base it on a percentage of the contract financed. That seems like a really bad metric. Shouldn't it be a percentage of the actual cash value of the car?
100% it should be. And it could be honestly 100% of the cash value of the car beside repos, because that would make more sense.
Yeah.
But unfortunately,
taking my grosses just so I can hit my advance rate of 65%.
That's right. But unfortunately, that's not the way the lender set it up. And so it's counterintuitive for the dealer, but they don't know that. And it's in direct opposition to where the lender should be.
Mm-hmm. Could I lower my interest rate, the interest rate I charge?
I would not say do that. I would say I would be in favor to lower my gross before I lowered my interest rate. And some people may be capped in their states, so they need to make sure of that first. But I would, if you're selling an ACV of, let's call it 10,000 and under, you should be max state rate. You should be, because the interest money is only taxed when you collect, or when it's collected. That's just the easiest way to say it. That's not when it's earned. So tax wise, you're more advantageous to have a higher interest rate and a lower gross.
Hey, just to jump in real quick and make sure you guys know about Buckeye Risk Services. Still a great sponsor of the podcast and a great partner to have at any dealership.
Yeah, sure. Retail, buy here, pay here, no matter what. Tax planning is so important, and using a reinsurance company not only helps you with your tax plan, it also helps with generating wealth. And when you get toward the end of your dealership, you need something else to pull money out of, and it's a great way to just force savings account, right, Jeff?
Forced savings account. So if you are a dealer, buy here, pay here, retail, and you're doing 20 to 30 cars a month, call the guys at Buckeye. You will not regret getting a reinsurance company set up. You can sell your service contracts. You can sell your ancillary products. You can reinsure for your post-sale inspections. You can, of course, set up your CPI, collateral protection insurance if you're a buy here, pay here customer. Massive opportunities to build wealth and forced savings for rainy day funds.
Yep.
Good. Give the guys a Buckeye a call. So let's talk about how I determine whether or not my grosses are too high and if I'm charging too much for my cars, because I think that's important for dealers to understand. And I have found that you need to look at the percentage of your customers who are making it to the end of their loans.
Yeah.
And I think there's a reasonable expectation. Now, of course, it's going to vary based on your demographic, your geographic, maybe a little bit. We do know inner city folks and some of these other areas just might not ever make it to the end of the loan based on life changes and things like that. But when you run a static pool on your portfolio and you look at different time frames and different groupings of loans, you can see how many of my loans are making it to the end and how many aren't. And that's a really good indicator of whether or not I've got my loan stretched out too far. I've not got my loan stretched out enough. You know, it's okay for not everyone to make it to the end of the loan. That's part of buy here, pay here.
Yeah, it is.
You shouldn't have nobody making it to the end of the loan.
No, you shouldn't. And also another metric to look at is severity of loss. And you need to be within an industry standard of severity of loss. And what I'm talking about is every time you take a charge off, what is the full charge off minus the ACD of the vehicle? What is that number leaving you? You know, before COVID, that number was for me in the 4,500 range. Now after COVID, because of the way grosses and prices and everything, it went up to $6,700, right? And so if you're $8,000, $10,000, $11,000 severity, you're overpricing your cars.
Yeah. And I want to put obviously the clause around that is when you said industry standard, because I can't compare that to my regular, like you just said. I look at my severity now and I think, oh my goodness, this is insane. But it's not because I'm charging too much for cars. I still think I have the same gross profit as I did before, even less. So yes, my severity, my charge off has gone up, but it's not because I'm overcharging. It's just funny money I'm never collecting. It's literally because the wholesale market corrected in the meantime.
Yeah, I think over the next, in 2026, I do believe that you'll see more severity is going to level out and we'll probably get back to a baseline that makes sense. I still believe that number is going to be $6,000 to $7,000 is where the baseline is going to probably end up. If I had to guess, if you're charging a reasonable, possibly more than reasonable, gross profit for your car.
Yeah. Okay. So we talked about term as being kind of a hidden killer, which led us down the road to a bunch of different things of gross profit and all that stuff. Anything else on the underwriting side of a healthy portfolio that you see is maybe out of the ordinary or the dealers are not paying attention to?
I'm going to tell you inventory quality is a big deal. Gig work is a big deal. And if you're not underwriting properly for gig work, you're going to have charge-offs and you're going to have excessive charge-offs.
That's a hard one because I have a small portfolio. We don't do a ton of loans, so I can really dig in as best I can to prevent the Ubers and the DoorDashes and the Instacarts and all that stuff from happening, but it's still happening. I know it's happening because I'm standing at the freaking restaurant and homeboy walks in to pick up a Grubhub order and I'm like, dude,
I was with you.
Temp tag.
Yeah. I was with you.
Yeah. And our freaking temp tag is still on the stupid friggin' car. And he's so sure, my blood boils and I say, well, how did we not catch this in underwriting? But it's impossible to control because these guys, they do pick it up. They get into it. They need extra money. They can't make their new car payment and insurance or CPI payment. So they go and they pick up a nighttime, DoorDash gig and they start running their car around.
Those aren't the problems. Okay. I had this conversation with a dealer last week and they have a large penetration of people gigging is let's call it that.
Giggity.
If the gig worker has a full-time job and they're just picking things up in the night or doing that little extra, I think that could honestly at times
so bad
help. It can help these customers because it's instant cash and they can make a payment when they maybe couldn't. So I think that,
and they have a base income. That's
Yeah.
important.
Yeah. Yeah.
Not
Yeah.
trying to make their whole monthly nut from gig working. They've got their base income that's covering everything. This is just that little bit of extra to maybe help with the payment or the insurance or whatever it is.
That's right.
And on the flip side,
Someone who walks in and all their income is Grubhub and there's a couple other things that I don't even know what they are, Uber Eats and all these things. If they're doing that, they're going to kill your car. You do not need to finance them, no matter what.
you don't even think if a short term higher payments, like do you just set the contract up for that kind of commercial work, or do you just send them down the road and say we don't do?
If this is a hard one, Jeff, because the answer to your question is yes. If you can structure the loan to last the length of the car during that, then yes, let's do it. But who was it? We were somewhere, Jeff, and somebody had just gotten out of a car. I think it was Andreas. Actually, he had just gotten out of a Uber, delivering him to the hotel. It was like a 1-year-old Kia Forte or something to that effect, and it already had 140,000 miles on it. And the guy had financed it for 72 months or 84 months, knowing that he was going to be a Uber driver the entire time. It's not going to work. It's just not going to work because that person should be paying that car off in less than 3 years, and he couldn't afford it. So you're done.
Of course. But if you structure it in a way where it's like, hey man, this is $1,000 a month for 12 months.
If you can do that, then
using it for primary work, and I'm going to check the miles or whatever you want to do to set it up, you probably could. Now, what happens when you find out, say the customer comes in for service work 3 months later, or comes in because their warranty, and all of a sudden you see they blew through their miles in the first couple of months? Do you cancel that contract? Do you shut them down? Do you call it due? Or do you force a refi?
I don't think you're in a position to do any of them. Unfortunately, I think you made a bad loan. And in that situation, if they were one day, $1, I would be repossessing them. And maybe not that quick, but you need to have your finger on that account. It needs to be noted in your DMS. And whenever there is a hiccup, they don't get the leniency that every other person that doesn't do that in your portfolio. It's just a different rule set for those customers.
Not that you make different rules for different people, but you may be inclined to be more strict with your rules that you already have set up, because of course we treat everyone the same. But some people do have clauses in their contracts or separate contracts, or even in the retail installment contract that says this is not for commercial use. If you can prove it and you want to go to battle over it, I don't know, call Steve Levine, ask him first, make sure your documents are vetted through him before you go down that road. But
I'm sure it would give you
good argument.
I'm sure it would give you reason to repossess. But that's really, do you want to jump down that hole? Because they're going to default in another way anyway. So just wait for that default to happen. Repossess the car.
They show up with a blown transmission and they're out of warranty now because they blew through the miles. It's staying with you. It ain't staying with you to put a transmission in it.
That's right. That's right.
Hey, real quick, since we're talking about collections, all things collections right now, we brought on the actual pro at collections.
Yeah, she's we'll call her the Robyn, if I say the Wicked Witch of Collections, is that bad?
I prefer the Queen of Collections Hearts, maybe.
Your Halloween setup was the Queen of Hearts, right?
Yeah.
And I was thinking the Wicked just came out. Anyway, so
Sure.
let's talk about AI and collections, because it is so important moving forward here. If you're not using AI in your collections, and we discussed that a lot of my boot camp, then you're going to fall behind, right?
Truth. AI in the year of our Lord 2026 is, if you're thinking about bolting on AI and going, that is a press release, not a product strategy. AI is a big elephant. And how do we eat an elephant?
One bite at a time.
One bite at a time. So as we're thinking about and we released AI general population. Well, so Blitz Collect, which is our AI piece, to the general population in the middle of December, and the statistics are pretty interesting.
Well, let's talk about those statistics and how it actually works. This is, as I recall, this is a agent talking on the phone back and forth to someone, correct?
Yeah.
Wow. That's so crazy, Jeff.
Yeah, it was really cool. We talked about this. This was like not even 2 months ago or so, right? So what have you found since then? Give us the stats on how it's being adopted, what kind of response rate you're getting. Because at first I say, I don't know, AI talking on the phone, like I'm a little worried about that. But tell me how it's working.
So just like in everything else, nobody answers the phone. 85% of phone calls go unanswered. But the interesting part is it's a call to action. The AI dialer is a bot that's dialing your customers so that your collectors don't have to be. And what it is a call to action for those consumers. Hey, they're calling me, whether it's AI or a collector, it doesn't make any difference. It's paired with a text message. The combination, here's your engagement, and we're seeing 14% increase in payment velocity and payment volume with an AI call. So we've got dealers on the program today that are using it as a reminder call. We've got dealers that are using it in 1 to 3. We've got it really is just like create your queue and then go. There's 2 voices. Allison is a little more friendly. Alan is very direct. So you can, it's kind of magic. It's really cool to watch.
Help me understand that. So Allison, you're saying, so from a collector standpoint, I've got Allison making these outbound phone calls all day long, right?
Yeah.
And if the customer answers, Allison actually interacts with this customer and gets info.
Absolutely.
If they don't answer, now Allison will leave a message and say, hey, reminder, just Allison from Four Seasons Auto letting you know your payment's due tomorrow.
What I was going to say is it's kind of a way of sicking the bots on your customers, but that's not super nice. It's what you're doing is you're taking like busy work where people don't answer the phone and collectors get frustrated and it's just boring. So run a queue in minutes and then let your collectors work on customers that actually need engagement.
And what I was going to say is, after being in dealership after dealership and working on collections with dealerships, the one thing I find is that early part of the queue, which is the easiest time to get promises to pays, gets neglected from phone calls. A lot of text goes to these people, and they're really bad text. People are texting the same thing a million times, and they're not changing it up, and there's no call to action. That phone call from a real live human being or AI is going to make a big difference in those early promise pays, right?
It makes a remarkable difference, and you've got to be first to the well. You've got to be first to the well, especially in tax season. Tax season coming up, you need to be paying attention. Look, this is a combined package. AI is a piece, it's not the plan. We're talking about automated intelligence. You're talking about using AI, and you're talking about using automation and engagement to get your customers, like to get them in a funnel and get them to where you need them to be. And there's information if you don't get them where you need them to be. Now there's information, right? Whether it's good or bad, if they don't make a payment, and they have received an AI call or they've opted out of the text messages or whatever that looks like, that's information that then helps you make risk decisions that are better on your portfolio.
Is this going to ever take some of my collectors' jobs?
It depends on how many collectors you have and what they're doing. Will it replace what we have seen is it doesn't replace collectors, it replaces new hires.
And that
with less. If I can go through my queue in minutes and know like where I stand, I've got the information. You guys, as dealers, so much data comes at you about your consumers and about what's happened, like more data than you can ever, even if you've got it and you can see it, it's more than you can ingest and make sense of.
Yeah.
This is data that's coming at you that you can then distill down and make sense of, and not just make it consumable, but make it actionable so that I can go out and do something with it. All this information is super relevant, and as the economy does whatever it's doing, as buy here, pay here struggles, as consumers struggle, you need every additional arrow in your quiver that you can to help your consumers pay.
Yeah, I like that. And when you say, when is Allison going to start like stalking my customers' Facebook pages to find out if they were at the casino over the weekend and have that conversation with them?
I mean, don't think it's not coming. This industry waits for people to fail before we give them a tool to succeed.
That's it. That's interesting.
That's kind of my mic drop for 26.
Yeah.
Get in front of it.
Yeah, you have I said this during one of my sessions that whatever is brand new today, and Robyn, I think I may have gotten this to you, but whatever is brand new today, 3 weeks from now is going to be ancient history in the AI world. And so you've got to use it right now, because if you don't, you are going to be so far behind when you decide to use it a year from now that you're not going to be able to catch up.
Robyn, can you give us a little teaser then? Like, what's coming? What is the next step for this? Is there any kind of foreshadowing you can give us as far as what BlytzPay's got in store for this technology?
So my architecture for the original BlytzPay has always been, I don't want to build buttons on the microwave that you're not going to push. So I had an opinion about like what we were going to build and how we were going to build it. We were going to do promise to pays. We were going to do all of these like pieces inside that the bot could do basically the job of a collector. And here's the reality. Nobody answers the phone. Nobody answers the phone. So this isn't a lot. We're collecting data right now. We're watching how our dealers engage and how the consumers engage with the automation as well as the AI. And then we'll make those decisions as it comes up. There's some really cool opportunities. Text engagement from an AI perspective, like Blitz Collect Text is I mean, that's our foundational piece. Yeah.
Sign me up.
Yep.
And I tell you, that's what's great about having vendors like BlytzPay. They support us as a podcast. They support us as an industry because it's hard for small businesses to understand all this technology comes at us. So, Robyn, thanks for you and your team for building that process and not throwing things on us we don't need. Build it as we go and as we can digest the data, and that's great for us.
We love it, and we want all the feedback we can get. One thing that I want to bang this drum just a little bit. There's lots of competitors out there that are doing these things, that are doing AI collections. If you don't have reporting and you don't have compliance on your roadmap, that is hope. That's not a plan. That's not a plan. So in Blitz, you can see we're partnered with DMSs, we're partnered with AMS, we're partnered with IDMS, we're partnered with Emotive, so that you can see what those calls look like, that those calls are actually being made. You can see the success rates. You can go in and listen to calls if AI does happen to have a conversation with someone. I just want to emphasize that whatever you do inside your dealership, if you can't track it and you can't substantiate it, that's hope. That's not a plan.
Yeah, absolutely. Great. Robyn, thank you so much.
Thanks, guys.
Okay, so now let's transition over to the other side of it. So I did the loan. It's a bad loan. It's a good loan, whatever it was in the beginning, but now it's starting to go south. Where are you seeing dealers lose it on the collection side when it comes to their portfolios? What are we missing? Now, we all know the basics. Make your phone call, stay in contact, put your hands on them, check the GPS, make sure they got CPI or current full coverage insurance. What else are we missing from a goods collection policies and like protocol?
Yeah. People miss recency way too much. Their collectors don't focus on it. The owners don't focus on it. And really with buy here, pay here customers, it's all about recency. And that means like if you have weekly payments, you don't want to see them going over 7 days recency, And if they're biweekly, you don't want to see them going over 14-day recency. You got to have your finger on recency. If you can stay on recency with full payments on recency, I should caveat that, and recency of contact, recency of seeing the car, we need to make sure we're on recency. And if you can stay on recency and stay in contact with that customer, 99% of our buy here, pay here customers want to pay, unless they have a life event. Then we got problems. But if you have recency of communication, you know what's happened.
Yeah, talking to them. Now, I know a lot of dealers, we talk about this all the time, is you do have some restrictions based on your covenants and your loans as far as refis, deferments, things like that. So those can be tools used in the right situation. And I know we've talked about those at length. The other thing that makes me think about is when you talk about recency is make sure your collectors are paid in a way that aligns with what you want to see out of your portfolio. And we've been down this road before. Again, I know that also. But if you have a collector that's motivated by money and their pay plan is not based on them making any more money on recency, delinquency, charge-off severity, charge-off amount, all those things, then you guys you're not lined up. You're not going in this, you're not rowing in the same direction. You're expecting them to go left. They're trying to just float.
So typically when I talk to dealers about their collector pay plans, it's we pay on delinquency. Okay, great. What else?
Yeah.
What else is it?
1 day, $1. That's all we care about.
There's a lot more to it.
30 days.
So it's delinquency, it's recency, it's charge-off percentage, it's repo redemption, it's how many times did I touch this person. All these things have to come in to the pay plan that you build for your collector. If not, just like our salespeople, they're going to find a way around it. And they're going to find out, how can I work this pay plan to make the most money with the least effort? You can repo yourself into a great delinquency.
Yep. I guarantee I could come into anyone's dealership and within 60 days, we could have amazing delinquency, as long as you don't look at my charge-offs.
That's right. Or my recency, because I've just deferred everybody current, right?
Yeah. Or my recency. So with that being said, I think that having collectors who, they're aligned with what you want to see done, and those alignments or incentives, they change. And that's something that I don't do good at. My pay plan has been pretty set with my collector for probably a couple of years. I haven't varied it. And I do think that you need to let your collector know, look, I'm going to vary this within a range. Some of these numbers are going to change. Sometimes I'm going to incentivize you a little more for this, and this one's going to come down. But based on what I need to see out of this portfolio, I might put a huge bonus or a stronger pay plan for the next 6 months on charge off, percentage of my portfolio that's charged off. And then I might switch it and say, hey, I want you to really focus on recency. I think that's okay. I think it's okay to have a slightly moving goalpost for your collectors, because they can't just learn to work the pay plan the way it is.
Yeah. And during tax season, during February and March, those goalposts should be narrower.
Yeah.
So you need to make sure that you're expecting more in February and March than you are in June and July.
Mm-hmm. Percentage of side notes collected. That's huge right now during tax time. If you do side notes for customers, they got money,
Collect it,
massive.
Get it in the bank.
Do you see any other places dealers are dropping the ball? Let's wrap this up with maybe one more collection side.
One of the things that I taught during our during my buy here, pay here boot camp was it comes down to a couple things. Collectors don't ever, I shouldn't say don't ever, a lot of times don't ask for the payment. And it's so wild that you would do all that trying to get a communication and working through all this. And then the next thing that you do is you forget to, hey, can you pay right now?
I think that's important. Let's make that distinction. Hey, Mr. Customer, you'll be fine. $350 is due. Can you make that payment right now? The full $350 right now. Instead, what we say, When you going to be in?
When are you going to be in? So
I'll be in today. I'll come say hi. I'm bringing any money. When you going to be in? I'll be in Friday. Okay, cool. Bye. I'll be in Friday. When? With what? How? I don't get paid Friday. I get paid Tuesday.
I'm going to give these 6 golden rules that I made up for the boot camp. And then the last one's going to be the most important. Stay calm when you're talking to a customer. Number 1, use questions instead of statements. We want to know what's going on with our customer. Never debate a hardship. It's just a losing battle. You're not going to work.
My grandma died.
Which one to work? Which one? The 5 that happened before? No. Don't anchor the conversation to the vehicle and about how important the vehicle is to the customer.
That's really good.
Super important. Get a path forward. And if that is paying right now or paying next Friday, let's get a path forward so that we're all on the same page. And this is so key, the last one. Always get a time when they're going to pay, the amount they're going to pay, and the method that they're going to use to pay it. If you do that every time before you leave the call or a text after they've responded, you are clear, they are clear. So if there is any alterations to that, you can go back and say, oh, this is what we said, and you didn't do it. That's the reason your car is disabled or repossessed.
Yep. I love that. The when, how much, and how.
That's it.
And then I like to ask a 4th how. How are you going to get that money? Where is that money coming from? Because I know that's not your payday. It can set you up on your paydays.
That is key.
You promise.
You promised me this Friday. Do you get paid this Friday? Yes. What time of the day do you get paid? 8 a.m. Okay. We're going to set up an auto draft at 8:01 a.m. Is that cool? Yes. Yeah. You got to click it when I send you the link. There you are.
One thing we just said that distinction, but maybe talk to me about your attitude on, I don't really like that. And I said, you told me you would pay me on Friday. I don't like that you would pay me. You're not paying me. My collector, I'm not the bad guy. I'm not the collector. I'm your advocate with the bank.
Yeah.
So I do like them to say things more like, hey, what can I tell the bank? Can I tell them you're going to be in Friday at 5:00 with $500 money, cash? Can I tell the bank that? Great. Let me go back. Let me go to work for you. Let me go to battle with the bank. The bank's the big bad guy. Hey, Miss Customer, the bank really wants to pick up your car today. Can you bring that full payment in before 5:00?
Be an advocate for your customer.
Always. It's never you and me. You promised me. You told me. You owe me. You'd better bring me the money. I just don't think that works, man.
It does.
I think the bank has to be the bad guy.
That's right. And the more your collector can be an advocate, the more likely the customer is going to communicate with that advocate.
Exactly. That's the bottom line. When you're the bad guy, they just stonewall you. They stop answering your phone calls and your text messages. Now, when you're their advocate, they know they can get you on the phone and, hey, can you tell the bank to give me 24 more hours? Sure, I'll do that for you. We're buddies. Like that's what you need is you need to make sure those lines of communication stayed open, because when you say, hey, pay me or else, okay, then I guess we don't have anything to talk about because I got no pay.
Or else.
Yeah, or else I just stop answering your phone calls. So for sure, absolutely. Luke, great stuff, man. Good stuff for us to remember this time of year. I know I see a lot of applications coming through and underwriting, and it always makes me anxious as to what our repo rate's going to be like in 3 months or 6 months, when we come out of tax time. But it's a good reminder for all of us in the industry to stay on top of that right now.
I'm just glad I don't have to deal with it.
You suck. All right, buddy. Talk to you next week.